afternoon, everybody. Welcome to Trader Merlin Show. It is your, I hope it worked. There we go. It is your, what day are we on? We're on Tuesday, Taco Tuesday. I'm in my comfort clothes. It was still under the weather, guys. I'll be battling this cold for a few days, but hopefully we'll get past it. A much better day, at least for me anyway, from a market perspective. I hope you guys had a great trading session. Now, I mentioned yesterday that I would do a little bit of a dive into stagflation today. And I think it's a very timely topic. It's important because we had this discussion a couple years back. I want to say it was probably 3 years ago. I'm not exactly sure the date. I'm sure somebody could find it. Where we had this discussion of stagflation and why it's so important to our markets going forward. Because typically, central bankers can manipulate things to help get the markets on track. And of course, you've heard Bill Addis, one of our regular guests, which we'll get him on here in a couple weeks when we talk about the next FOMC meeting. But Bill says his biggest concern is stagflation. Right? He's fearful of it. And I get it. It makes sense because stagflation is one of those tricky situations that it's hard to get out of. So I thought it'd be nice to revisit this, and not to say we are in stagflation or headed into stagflation. It's more of a discussion, and I'm open to all of you participating today. This is not me here to pontificate or spread my opinion or influence you. It's let's look at the facts, right? Understand A, what stagflation is, and B, let's look at the data to get an assessment as to are we in stagflation? Are we headed there or not? So let's start with the graphic for today. Stagflation 2025, a big ominous headline there, but I tried to make the graphic pretty cool with, it's all about the numbers, right? It's all about the data. So I have the Neo streaming data in the background there to give you a better idea. Yeah, my 49er hoodie, by the way, you want to talk about the markets getting dismantled. Talk about the 49ers. Jeez Louise, we're getting rid of pretty much all of our good players. Drives me, it's crazy. It's a rebuilding year, they say. Anyway, let's go into the stagflation topic. Now, for those who may be new, typically you're in this discussion of one of two things, which is inflationary environment or a deflationary environment. That's usually what the discussion is. And we oscillate back and forth, kind of have this feeling like we're in an inflationary period right now where prices are rising. However, when you start to add on different components, the picture may change a little bit. So what are the three components of stagflation? Well, I think this is either Grok or Midjourney created this image. It's a combination of three things. Number one is going to be the inflation component, which will start there. Number two is going to be the unemployment component, meaning do people have jobs? Are they working? And the third component would be economic growth. So let's start with kind of the big picture here on the inflation side of things. Of course, inflation's been one of those hot topics for years now because we really surged in inflation. Our numbers got very, very high, and they did aggressive actions to stop inflation, right? We saw those Fed funds rate rise aggressively to help fight inflation. I'm actually going to bring that up for you right now. I'll go look at the FOMC meeting here. Bear with me. I'm looking at all kinds of different data for you today. We're going to do a lot of chart looking. So let's go remove this one. We'll put on USD, and I will go to the 19th of this month, next week. So here, I thought it was March 19th was the date for the FOMC meeting. Maybe I stand corrected here. Let me remove this. Oh, that's why. There we go. Remove all. And now apply that filter. Okay, so here's your FOMC rate projection. And just to give an understanding, back here when we were in 2021, 2022, inflation really started to surge. And you can see what they did here. They raised aggressively. And for the podcasters, liftoff happened right around March of 2022. When I say liftoff, it's because from 2021, March of 2020 to 2022, essentially 2 full years, we were stuck at zero, right? 0.1 or less, right? Very, very low, 0.1 quarter or less. And then we lifted off and we went to 50 basis points and then 100 basis points and 175. We're talking like 75 basis point increases here until we maxed out at 5.5%, which is where we were going all the way back into July of last year. And now we see it start to lower. We're cutting our rates. So that aggressive increase here was designed to slow down inflation. And the good news is that it worked. Now, there might be impacts here on other things, but right now that goal of the Fed, remember they have a dual mandate. Their dual mandate is make sure we have stable pricing, that essentially means low inflation, and their target is 3%. Also, 2%. Also, make sure we have full employment, which we'll look at here in just a second. And Big Ev says the Fed is always late. I would agree. I don't know if it's necessarily always late, but a higher percentage of the time they're going to be reactionary, because if they anticipate things and they screw up, then they're in trouble. So yeah, I agree with that they're, for the most part, going to be late to the party with regards to what they do. So inflation. What inflation numbers do you want to look at? We'll start with our first calculation, which is going to be the core PCE price index. And we can see back here that inflation, this is a month-over-month change, was really surging back in 2021, right as they were raising those Fed funds rates aggressively. And we could make the argument that inflation seems to be under control at this moment in time, right? You can see on the chart here that the monthly core PCE price index number hasn't increased more than 0.3% for at least going back into February. So for right now, if I were to annualize 0.3 times 12, that's about a 3.6% inflation rate, which is certainly higher than what the Fed wants, but I would argue not horrible given historical norms. So inflation has been helped by the aggressive raising of rates. Of course, I just brought up that chart of the FOMC where you can see we've been lowering. We were at 5.5% back in July of last year. Now we're at 4.5% currently. And the expectations are we may start to see more declines this year to help get this economy back on track, which many people feel it is out of whack and not functioning properly. Remember, the more that we lower these Fed funds rates, the more that's going to contribute to higher inflation. At what point does it really start to trigger? I don't know. But I do know that the lower we go, the more it will impact down the road. And again, this is stuff that's not like they lower it immediately and it's an instant change. It takes time for the stuff to filter through. So, how many of you think, let's do a poll here. Maybe I could do more polls just for fun. Let's do a poll and we'll say, is inflation, tough to type and talk at the same, ION is going higher. Man, try to talk and type, HIGAER. Okay, so here's my poll for you. Inflation is going higher this year. Simple question. Again, I don't think there's a right or wrong answer. It's an opinion about what you feel. And I'll give a couple of polls here so we can start to paint that picture of what's going to happen for our markets going forward. Now, the interest rate piece was critical in controlling the inflation rates. It's not the only tool, but it's certainly an important one in keeping inflation under control using interest rates. Now, we have new entrants coming in, which is going to impact inflation and could impact it very significantly. Of course, I'm talking about the tariffs. So we've got 25% tariffs on certain goods from Canada, 10% on energy, 10% on potash. You got tariffs on Mexico at 25%, and China you're looking at 20%. And now there's more talk about potentially scaling this up to the European Union and other countries, India as well. Now, tariffs are a tax, and in a couple ways, it could certainly damage the economy. In chat, go ahead and type in what you think tariffs do to inflation. What would tariffs do to inflation in the United States? And this is kind of a tricky one. I don't think there's a clear-cut answer. I have my opinions on what tariffs would do to inflation, but I'm curious what you guys think. So I'm going to end the poll here. It looks like about 78% of you guys said yes, inflation is going to be higher this year. Okay. I don't know if any daily goods that have gotten cheaper, let me know if you can think of some. Yeah, it's tough, Steve, because there are some items that have dropped in price, right? We've looked at some of the commodity markets in particular. For example, I'll real quickly bring those up for you since we're on the topic of inflation. I apologize if you guys get a rogue cough in your ear. I'll try to mute my microphone. But, here's cotton. There's something that's dropped in price significantly. I mean, you want to talk about a big slide in percentage from its peak on December 18th to where we are today. Cotton's down 35%, but I haven't seen my t-shirts get any cheaper. Sorry, that's cocoa. My bad. It's cocoa. Cotton also been on a pretty aggressive slide. If you go back to September of last year to where we are right now, it's down 11.6%. You have meats, that's going up, right? What about coffee? Coffee surging higher. Here's your lean hogs going higher. Orange juice, actually, really shocking, is just absolutely falling apart. I actually do think orange juice is ready for a bounce here. It's down 49%. Wow, 49% for orange juice in just the last 54 trading sessions. How about sugar? Sugar fell a bit. You have corn. Has been really aggressively strong, but over the past couple of months, it's fallen. You have soybeans, it's declining, and wheat, right? Wheat really has had an aggressive sell-off over the past couple of weeks. It fell at one point down 15%. Currently, we're sitting down around 11% decline for wheat. Now, if we want, we can go to RBOB and look at gasoline futures. Right, over the past couple of weeks, gasoline certainly has had a pretty big slowdown, about 12% decline in gas prices. I would argue that the rents are increasing, which is a big component of inflation. So there certainly are elements that are declining in price, but I don't believe those discounts, those price declines are translating through to you and I as the end consumer, which leads me to believe that that will translate into better profits for those companies. And again, if I'm a restaurant, let's say I'm, let's say I'm Kellogg's. Go look at Kellogg's here. If I'm Kellogg, which uses, what's this? Forget the ticker symbol for Kellogg's. No, I don't think that's it. What's a good, how about, what's a good example? How about Hershey's? Go look at Hershey's. Here's Hershey's. Now, I don't buy a lot of chocolate, but I don't see the prices in the store of Hershey's products declining. If you look at this price chart here, I know that we have people listen to the podcast that can't see this, so I'll just real quickly explain to you. From the high price in December of 2024 to the low point in February of this year, the price of chocolate dropped 32%. Well, just over the past few weeks, it's been on, this is the price of Hershey's. Hershey's stock has surged 38%. And that certainly lines up with the chart of cocoa, which has been falling. So as cocoa continues to fall, Hershey's makes more profit, yet they're not lowering the cost of the Hershey's products. Therefore, bottom line is more profit for Hershey's. And I think this could be the same thing for others. Yeah, NJ, thank you for that one. Kellogg's used to be public, but it looks like it went private. I think it may have gone. Let's go KLG. You guys say KLG? Is this the one? Well, it would make sense if it's KLG, right? And you look at the chart of wheat here. Wheat certainly had a big fall over the past couple weeks. Although I would argue it takes a lot more time to let this filter through to the end cycle. But if it continues to fall, then Kellogg's should have more price increase because again, they're not going to lower their boxes of cereal prices because they're still selling. Right? John O'Donnell, one of my good friends and mentors, always says the cure for a high price is a higher price. You and I are not privy to the back end of these businesses, whether that's a gas station, a hamburger joint like McDonald's, or any company that's reliant on commodities. And I'm pretty sure that most of these businesses have seen a slight decline in consumers, a little bit of a drop, but they're charging so much more for their products that fine. If I was charging $1 for an item and had 1,000 customers, that's $1,000. But let's say I can now charge $2 for that item and I lose 10% of my customers. That means I have 900 customers now at $2. I'm now making 1,800. I've made 80% more profit. I have fewer customers to deal with. Why would I ever pass on that savings to you? This is a total win for me. So if you want to really get prices lower, you boycott, right? You go out there and you stop buying at these places. So even though some numbers look better, I don't think it's done. All right, so let's see. I asked you guys, what do you think about the inflation impacts of tariffs? So you could argue both points. On one argument, you could contend that because you're going to an economic battle with other countries, meaning a lot of our goods and services may go out of those country borders, and now they're not, demand for your products and services could decline. And if that happens, that actually may be deflationary on one hand. I think a lot of people are under the impression that it could be very inflationary, which I think there might be, depending on the company, there probably is a better argument for deflationary because it's going to result in economic slowdown. And that means demand for these goods and services could decline because it's not being shipped over to China or Mexico, or the reciprocal tariffs could impact us as well. So that's your inflation side. Let me make sure I get through your comments here. Tariffs raise overall costs for producers buying individual materials, supplies, as well as, yep, absolutely. I mean, oil is down, but oil and gas are higher now. How is that? Well, I mean, we could talk about the oil and gas stuff. So I brought up RBOB, which was gasoline. And unfortunately, I have deleted my dollar index from my chart. This should help us from an inflationary perspective. I'm looking at crude oil chart right now, and we've been talking about that little yellow box. That yellow box is between $67 and $65.25, and we're just bouncing back and forth for the last 5 days inside that yellow box, and I don't see that changing at any time soon. The reason this is important is if that's broken, you could see some pretty big downside movements here. And again, Trump has said drill, baby, drill over and over again. That just leads me to believe we're going to have a lot more supply coming onto the marketplace, a lot more supply domestically coming onto the marketplace. But then again, we may have an issue with offsetting supply coming from Canada. If we continue to raise tariffs on Canada, charging them an extra 10% for energy products, well, that might drive people more to consume U.S. So a lot of this has so many different domino effects that may impact it. But let me continue on because I'm rambling on about inflation. So inflation, I do think is going to get significantly higher because the cost of the tariffs, right, being passed on is going to increase. Obviously, goods coming in from Canada, 25% higher, Mexico, 25% higher, and China, 20% higher. So that's going to pass on to you and me, therefore, inflationary. And it's going to be more inflation. Are they in credit to do so? Consumer credit is way up, and that's something that's just not good in my opinion. All right, so inflation is the first point. I think 77% of you thought that we were going to see inflation higher this year. To be clear, I don't think it's going to get to the point that inflation is that face-melting, Indiana Jones face where you're just like, oh my gosh, we're at 30, 40% inflation. I don't think that. But I do think we're going to get to the 5, maybe 6% inflation here if the tariff wars continue, because that cost will pass on to you and I, and therefore inflation goes up. Now, what's our second step here? Second one's going to be unemployment. Remember, it's a dual mandate by the Fed. They must have full employment. That's their goal. Now, this is where things get a little bit wonky, because what is the definition of full employment? You guys know, because most of you are regulars here. Ben Bernanke has said 5.5% is full employment. So I'm using that mentally as that's my line in the sand for full employment. I'm sure other people would have a different read on this and say, it's a different number, Merlin, different number. I'm happy to hear your argument as to why it should be 4.5 or 4 or whatever number you think it is. Totally open. I don't have a dog in this fight. I just know that from the horse's mouth, Ben Bernanke, 5.5% was the number that they used. Now, here is a chart of unemployment going all the way back into 2005. I'm going to put my cursor on 5.5%. Now, I know it's going to be hard for some of you to read, but there is the 5.5, that's like 5.4. Let's go up one, click. There you go. There's 5.5%. Really, since 2015, we have been predominantly well below. I mean, well below 5.5%. The only time we surged above it was because of COVID, and of course, according to this, our unemployment hit close to 15%. Incredibly high. Now, if you look at where we are today, 4.1, this is literally lower than anything from 2005 all the way through 2017. Now, I'd like to go back even further, so let's go back as far as I can go here on this one. And I'm going to put my cursor at 4.1%. The last time before 2017 that we were at 4.1% unemployment was all the way back here in the year 2000 when the markets crashed, 2001 to be precise. So we are at a very, very good spot from an unemployment perspective. That said, when we zoom in as opposed to out, that picture does show unemployment increasing. Now, obviously we want to have full employment. If unemployment does creep up from here, and you guys tell me, what do you think it should be, quote unquote, full employment, the target employment rate? I believe we're in like la la land with regards to what our rates are right now, our unemployment rate is right now. 4.1% is dreamy, right? Love it. However, we do have massive government layoffs, and dang it, I didn't bring that dang chart up again. We had 10,000 government layoffs just in February, and there may be a lot more than that coming. That's just on the government front, and I think we'd all agree, especially because we have a government shutdown potentially looming here, that there may be a lot more government layoffs to happen. If companies see that there might be a potential slowdown of economic growth, what do you think companies are going to do? And we're already hearing about companies laying off employees, right? Facebook and Meta's already talked about their planned cuts. You had Schwab and JP Morgan talking about cuts. It will probably become much more prevalent in the next few months because of an economic slowdown, a slight slowdown. And of course, I'm a believer in the domino effect, where if you lay off employees, that's less consumption buys less goods and services hurts the companies and they lay off more, and that cycle keeps going and going and going. So Andre says 4%, Big Ed says 5%. So let's call it 4.5. I'll split the difference between you guys. Or, because I think 5.5, Andre says 4, we'll go in the difference and go 4.75. Right? Either way, we're pretty close to, or pretty far below that number at this moment in time. So the concern I have, let me get this up here. The concern I have right now is how quickly this starts to rise in the coming months. Right? I was on the Gary and Shannon show on KFI this morning. A friend of mine from high school is just so great to be on that program. So thank Gary if you're watching right now. Part of the concern is what's happening in our markets going forward. And my big mantra since the beginning of the year, as you guys all know, is the uncertainty of this market. It's more than it's ever been, in my opinion, from a political leader perspective, because you have, this Wild West kind of Trump attitude of just shock and awe. Fine, whether I like it or not is irrelevant. It's just I got to deal with it. So these knee-jerk reactions, in my opinion, are going to cause this unemployment number to rise. And I think the real test will be when we get to like here. No, actually not even that far out. That's 2026. Hold on. I just wanted to give a couple empty bars here so people could see, because that really will be the telltale. And I do think, maybe I should write this down to see how wrong or right I was. I think by the time we get to like August or so, we'll be right around 4.5%, showing that increase pretty significantly in a short window of time. Now, that, of course, would be a bad thing, because stagflation's three components are rising inflation, rising unemployment, and slowing growth. So far we've looked at two of those factors, right? If you look at that variable chart I had here, the first two, inflation, I think we're all pretty much in agreement that inflation, or at least of the opinion, that inflation is going to get higher this year. How high, we don't know. Could be a little, could be a lot, but all signs point to higher inflation. The second point of this triangle would be the unemployment rate. And given all the layoffs from a government perspective, all the layoffs may be happening because of AI and automation, or just companies trying to get rid of the fat so they can streamline and get ready for lean times, I think we'd all agree unemployment is probably going to increase. So we already have two of those components, in my opinion, that are looking good. Now, they're not showing yet, right? Inflation's not surging. Unemployment's not surging. This is just forecasting, right? I think none of this is taking place yet. The last part is your growth perspective, all right? What is the growth prognosis for the United States? Economic growth, obviously, is critical. And to the major metric we're going to look for that is going to be GDP. So here's your preliminary GDP. Right now, 2.3% is what they're showing there. I've heard higher numbers. 3.1, I believe, is the historical average going back into like the 1940s. So we're certainly well below our overall growth. And when we zoom in here, it has trickled down the past 3 quarters. It's not the end of the world by any stretch, but it certainly is getting lower. It was, blue is actual, gold's forecast. So it was 3% in August of last year. Then we dropped to 2.8% in November. And our most recent reading, we dropped to 2.3. So, we're losing 2 to 3/10 of a percentage point per quarter. If we slap on tariffs with other countries, as we're doing, right? They're implemented, it's on. This most likely will have a negative impact on growth. And we've already seen that trend going. And we saw the Atlanta Federal Reserve say negative 2.8% for Q1 of this year. That's not even remotely close to the numbers we see here. The last time we had a number even close to that was May of 2022, and that was a negative 1.5%. Atlanta Fed is saying negative 2.8%. Holy cow. That's not good. And even the drawdown we had here, let's go back to May of 2022, we actually had a 5% drawdown, followed by August, which was the worst of 2020, which was I'm talking too quick today. May of 2020 was negative 5%, and then the August of 2020, we were at negative 31.7. Now, I don't anticipate getting anywhere near negative 30% on GDP, but Steve says here 2.8% will send the markets tumbling. It will certainly cause them to falter, right? Does that mean it collapses? Probably no, but it does mean that the market's going to get it like, this is not good. Remember, 1 point data is not the tell-all. It's a sequence of, if we got negative 2.8 and the next quarter is negative 2.8, okay, now we have problems, right? Showing that consistent decline there. So I would argue that economic growth is the only one of these three that's actually really starting to show its hand. And what I mean by that is unemployment has been getting worse the last 3 quarters, okay? So we only have small amount of data here, but growth getting worse last 3 quarters. If we look at the unemployment rate, it's actually declining and not really that big of a factor yet, okay? So we don't have stagflation currently, absolutely not. There's no way you could convince me of that argument. Our third component was inflation, and inflation seems to be rather sideways at this moment in time. So to the discussion of are we in that stagflation 2025 kind of environment, I certainly would say no. I definitely in the camp that right now we are not anywhere close to, we're not in it, right? We've got inflation sideways, slightly up. Unemployment has been trending down the last few months, so we're okay there. The only one is GDP, which has 3 quarters of kind of declines. But time will tell. We may revisit this by the middle of this year. And I do believe that the signs will probably start to point a little bit more towards that stagflation, because I do believe that when we look at these 3 components of inflation, growth, and unemployment, that inflation is going to increase. I think the tariffs are going to get passed on to you and me. I think that they're going to try to print more money to weaken the dollar. That's the Treasury and Trump's objectives, are printing more money to weaken the dollar. That causes higher inflation. So I think inflation, for me, is almost a foregone conclusion. Second component would be unemployment, and I do think we're going to see a slow trickle up here as more layoffs. And it's not just because the economy is slowing, in my opinion. I think technology, not maybe the next few months, but later on this year, as more and more employers realize the benefits of AI, I think you're going to get rid of people. I'll give you a good example. We had a brilliant mind that used to work for us. He was one of the nicest guys you could possibly imagine. I love this guy to death. He was a phenomenal writer. And, for him to write a nice article would take probably, give me a couple days and you write a really good article on something. I can now accomplish the same thing in under 30 seconds. Now, it takes me longer to read the article than to write it. And I could have it tweaked. I could find an award-winning writer. Let's say Stephen King. Okay, I want something horror. I want a graphic. I want a really scary financial market newsletter. I could say, write a letter on how unemployment is so bad, and I want it written in the style of Stephen King. And it'll write that for me. So unfortunately, that individual's job, gone. And that's just the start of many different pieces. And if I was a business owner, as much as I want to help people and keep that guy around because he's a great person, I'm also in business about making money. So some business owners don't give a hoot about their employees whatsoever. I probably would lean a little bit more on the side of my employees and keep them around, but have to give them some different responsibilities. I think a lot of companies are going to feel that, and unemployment is going to rise. Our third component here is economic growth, and I think the tariffs are going to hurt economic growth. I think that's really going to slow things down for the U.S. Those layoffs, unemployment will lead to that as well. So while we're not there, I do believe that stagflation is maybe going to be a bigger topic around October, November of this year when the data starts to support that argument. For right now, we're not there. Big Eb says, Jolt's jobs report showed more open jobs in January than December, 7.7. Yeah, I actually thought we'd go down on that one. I thought we were going to see that trickle back even lower. So let me bring that up for you guys here so we can see that. Let me remove all these, remove all my filters, and we'll go to today. Here's your Jolt's job openings. I actually thought we would come out at 7.4, but apparently there's more job openings. Now, to be fair, right? To be fair, what kind of jobs are those? Are these real basic entry-level jobs? Are we losing the high-paying jobs? There's always that argument. Oh yeah, well, there's more jobs, but they're just paying a lot less. So I don't know that detail, but the trend so far if you look at this JOLTS job openings, meaning how many job available openings are there in the U.S., that number peaked in May of 2022 at 11.55 million, and now we're at 7.74. So we've got what appears to me to be full employment, but this number seems to be declining. And the trend is your friend till the bend at the end, right? That's the way I look at it. Okay, where are the jobs? Exactly, Oliver. That's my argument. So let me, oh, dang it. I wanted to include you guys in this conversation, so bear with me 2 seconds. I changed my animation here. When we look at the hypothesis, right, just the hypothesis of inflationary environments in our world, and we have the stagflation piece, how or what tools can the government and central bankers do to help right the problem, right? So let's say we have those variables we talked about: unemployment, inflation, and economic growth, right? What tools can our government utilize to manipulate those back in favor, right? What can I do to get growth back in the United States? What can I do to lower the unemployment rate? What can I do to lower inflation? There's different tools for each one of those things, right? It gets really confusing. And I'll wait for your discussion here in chat. Liz says, could you argue tariffs will promote U.S. growth, which is the whole point of tariffs in the first place? It's to promote American businesses, right, who apparently have an unfair shake in the global community. You could make that argument. You could make the argument that it would help certain American businesses. Absolutely. I think on one hand it can. On the other hand, I think it could hurt a lot of American businesses. For example, they're pulling all the American alcohol off the shelves in Canada. Well, does that hurt Constellation Brands and other companies that have liquor distilleries or exports into Canada? Certainly they might just not buy our goods and services anymore based off that. There is a lot of nationalist pride in Canada. I have seen a lot of protests, not so much in Mexico. I haven't seen any protests in Mexico, but in Canada for sure. All right, so let's see. Margaret says lower taxes. So these are the tools that we could use to fix the situation. We got lower interest rates, zero interest rates. That's the ultimate lower, right, Oliver? Tax incentive for individuals, business taxes, right? So let's look at the first one here, interest rates. So if we meddle with the interest rates, right, this is where it's so challenging for the market. Because if you meddle with interest rates, so there's interest rates and yields would be the first two I look at. But let's talk about interest rates. If we go back and start to manipulate the Fed funds rate, right, try to bring that back down. As you can see here, there's where we stand. And the talk track is right now they're looking at cutting it some more. And we'll look at those numbers here in just a second. Now, Margaret, I'm getting Margaret fired up today. The idiot's already paid for the liquor. It's future demand that may decrease. Future demand. I know. It is pretty silly. This whole thing is kind of silly. But if you look here, they're already cutting rates. And I think that this is probably what's caused inflation to tick up a little bit over the past couple of months, is this dropping of the Fed funds rate. And again, lowering this rate stimulates economic growth. So when we look at GDP numbers, dropping this should help grow GDP. However, dropping this also hurts inflation. It will increase the inflation rate at some point. So lowering interest rates has a multiple effect. It's good for the unemployment numbers because it'll foster growth. It's great for economic growth. That helps the employment, but it also hurts inflation. So you're shooting yourselves in your foot kind of on one front. Your second piece that I mentioned would be yields, right? Manipulating yields. So that is the short term, which would be controlled by the Federal Reserve. And then we can talk about manipulation of the long term. Now that ultimately is going to come down to supply and demand, right? What I mean by yields isn't just the short end, it's that long end of the yield curve as well. Getting out there into the 10-year. And how do we do that? Well, I think it boils down to two different things. There's two ways in my mind you can drop the yields. And ideally, what you want is to have the 10-year bond as low as possible. The lower that 10-year goes, the more money is going to be available, the more borrowing will happen, and that will spur economic growth. So if we want to fix economic growth, which looks like it's slowing, get that 10-year as low as possible. Lower the cost of borrowing. Great. What does that do to jobs? That helps create more jobs, economic growth, right? Lower rates stimulate that. That also creates inflation. Now, how do they lower the 10-year? Remember, Bill Addis will tell you that the only thing they can control is the short end of the yield curve. That's what the Fed does. The Fed also does manipulate the long end. They manipulate the long end of that yield curve, the 10-year, for example, which I will bring up for you guys right now so you can stare at something else other than my ugly face. Here is your 10-year yield. Ideally, you want this yield to get as low as possible. How do they manipulate that? How do they get this lower? Well, number one is they buy more bonds. They find more buyers because the more buyers for the 10-year, the lower rate they have to pay. It's a supply and demand thing. If nobody wants the bonds, they have to offer a higher rate. If everyone wants them, they can drop the rate that they're paying on those bonds. So you need to increase demand for these 10 years. And at the rate that we are pissing off foreign countries, that's probably not going to happen. I think Canada's already said they're going to start unwinding their bond portfolio of U.S. bonds. That's not good. That's more supply coming onto market. That is not necessarily a good thing. The other way that you get this to drop, again, number one would be you increase demand. The other way would be you buy more of your own bonds, which means the quantitative easing that the Federal Reserve has done buys more bonds. Now, what does that look like? Let's see. Let's go Fed balance sheet. Remember, the Fed has got a really cool feature to it. They can just print as much money as they want, indefinitely. Now, here is the Fed's balance sheet. Notice that over the past few months, it's been pretty awesome. I mean, they're $8.9 trillion worth of assets on their balance sheets, all the way down to 6.7. That is a remarkable improvement in removing the balance sheet, or reducing the balance sheet. If, and this is a big if they want to lower it further, the Fed's going to have to tick this back up and start printing money and buying bonds, because clearly China doesn't want to buy anymore. Japan slowed down their purchases. You have Canada saying, you want to tariff us? But we're not going to hold those. And Mexico was never a big buyer anyway. So that's the predicament we get in with yields is who's going to buy it? How do we increase demand for our bonds? Well, the largest buyer is the Fed. That will probably continue, which I think personally puts the U.S. economy in a kind of a perilous place. Because the more that they print, the more it dilutes the money supply. That will push the dollar index down, which of course does help economic growth. So man, there are a lot of really intricate, intertwined pieces here for this puzzle of stagflation 2025. Now, I know I could have gone much more in depth in many, many other areas of this, but this is where we stand. And I think that for all of us, watching what these markets have done over the past, let's just say 15 days, I think you're starting to see people get a little bit uneasy about it. That the predictable action of the Fed backstopping the market and constantly pushing things up, I think that might be done. Technically, when we look at the price charts here, things are starting to look a lot weaker. Now, before I go to those price charts, let me go to the FOMC just because I want to see what the Fed Funds Futures numbers look like right now. And let's see what we get at that March 19th. The expectation right now, 97% probability they don't do anything at the next meeting. What about through the end of the year? Oh boy. Now it is definitely shifting. There is more and more people believing we're going to see more rate cuts. Right now, there is a 37% probability of 3 rate cuts this year. And that's changed dramatically. If you go back 1 month, there was a 37% chance of 1 cut. Now it's 3 cuts. So that pendulum is really starting to switch lower to more rate cuts, which will further add to this discussion because, as we know, rate cuts are going to help inflation. It's going to push inflation to the upside. Merlin, do I think that the Fed is too late on this? Personally, I don't think that this is the Fed's problem. I mean, it is ultimately to fix the problem. I think what you have is this new administration just created so much shock, right? Again, I've mentioned this before. If you want to be successful at trading, any market, you come up with a plan, right? You've got to, before you even start, have a plan of approach to trading, period. And as you go, you'll see what the results of that plan are. And don't just plan for 3 or 4 trades. Let's just say 100 trades and implement that plan. After 100 days, you review. You look and see what you did right, what you did wrong, analyze it. Are there things you could have done better? And then what I would say is you make a list of all the things you did wrong and you change the most impactful piece in your mind. You change that, and you now try and see what the difference is. What impact does that one change have on your trading going forward? If you have a list of 15 different things that you know cost you money in your trading, and you change all of them at once, how do you know it worked? How do you know which action caused which change? And here we are now with complete regime change across the board. You've got a tariff war going on. You've got an internal war going after government offices and spending and taking away all this catalyst. Remember, when you cut spending, you're taking away economic catalysts. Now, I know a lot of the catalysts that economic catalysts that Elon Musk is looking at are international, U.S. aid stuff, but this will come home to roost, right? We are going to see domestic spending areas chopped as well, and that could also hurt economic growth. Because remember, that's less money being pumped into the economy to cause it to grow. In my mind, I do believe that a lot of what has kept the economy running has been government spending, and that props up the economy. If we stop all that spending, what happens? Things slow down, which, fine. Just make sure we got short positions on. I'm not short right now. I'm still got long positions, but I'll tell you, we hit a point where really shouldn't be long, in my opinion. Elon he sold it to him. It's funny because Trump doesn't drive. I don't think Trump can drive. I don't think he's allowed to drive. What else we got? You guys had a whole bunch of stuff. Sorry, I've been on a talk track here today. Even with sore throat and runny nose, I'm still talking up a storm. Fed buys up the bonds and puts them on their balance sheet. Exactly, John. They take money out of thin air, literally create it out of thin air with an entry on a keyboard, and that creates more dollars. That weakens the U.S. dollar, which we have seen here, right? And I think that's what the forecast is. Let me go here, $DXY. Let's go all right, notice what's happening with that dollar index. I think that the markets are saying this dollar is going way lower because you're going to have all those factors we talked about. All those factors lining up to really get a weaker dollar out there. So, I was bullish on the dollar for the longest time, and now it's kind of hard to be. When you have a central bank, not a central bank, when you have a Secretary of the Treasury and a president that both say we want a weaker dollar, why fight that trend? Why fight it? Let's see. And the Saudis probably won't. I read somewhere they need oil around $90 a barrel on their balance sheet. So not only do the Saudis I think they buy our 10 years as a sign of good faith, diplomacy, but they're already taking currency for oil taking money for oil in other currencies. It used to be you had to have U.S. dollar, and that's one of the concerns is there might be this petrodollar or a new currency that supplants the U.S. dollar as the reserve currency of the United States or of the world. I don't know if that's going to happen. I don't think that will happen. I think we'll just lose a little bit of our bargaining power here as countries like Saudi Arabia say, I'll accept payment in whatever. It's my oil. I'll do whatever I want. What else we got? Go grab your whiskey. No, no whiskey today. I need to drink nothing but water until I'm healthy. Only water, my friend. Let's see. He's going to allow his staff to use it. Cool. Let him. Isn't Trump trying to force Powell to do things? Correct, he is. He's been saying, I want you to lower rates. And bravo to Jerome Powell for not giving in. You got to do your job and do what you think's best and not be influenced. And there should be a separation there between Powell and Trump. But ultimately, there's a lot of political pressure that Trump can put on people and businesses and entities. But, when I was on the morning show today with Gary and Shannon, it's tough because we have this uncertainty, and it's escalated more than ever, which for you swing traders and day traders, this is great. For long-term investors, I think this could be quite painful going forward as we get just whipsaw after whipsaw. I mean, today it's like, we'll back off the tariffs a little bit. Markets have a nice little move up. Oh, no, way we're not. Okay, markets tank. Just chaos. Said he's going to pay full price. Wouldn't complain about favoritism. Yeah, I'm pretty sure Trump didn't pay for that thing. Pretty sure he didn't pay for it, but whatever. If he did, he did. If he didn't, I don't care. All right, so that's my discussion today. Which I know for some of you've already kind of understand it, but I do think it's important to think about because in the coming months, you may have to make some pretty hard decisions with your portfolio, right? How do I protect it? How do I hedge it? How do I maybe even just get out or start looking for the short play and go outright short? Right now, I still have some long positions. It was a great day for me from a trading perspective, so I'm okay. But this chart here, let's go to the S&P, doesn't look great. We actually were starting to move back up here. We had hammer formation as of last night at about midnight, and I was thinking we're going to have a nice big rally today, and we didn't. We got a little bit of a move up and then gave it back, down 0.78% on the S&P for the day. So I actually thought we would rally up and challenge our overhead supply level. And again, that supply zone is between 57.25 and 57.60. So I thought we'd get a retest of that and then sell off from there. We didn't really get much of a retest, so not looking that great. S&P was down 0.78 today. You saw NASDAQ doing much better, down 0.28%. And fortunately, the big benefactors here, or the big helpers, were your FANG stocks. Right. So yesterday we had Tesla down 15%. And by the way, I did make a mistake yesterday. I told you I sold the 210s for $2.50. That's incorrect. I sold the 210 puts for $6.50. For some reason I got my numbers wrong. So we'll see how Tesla works out. But Tesla was down up 3.79% today. Feeling good about that one. You had Nvidia, a little bit of a pop, nothing big, 1.66% move to the upside. And again, I have the 115 calls on my position right now. You had Meta up 1.29%, Amazon up 1.05%, Microsoft just call it unchanged. But then Google, which I think is going to face a lot more downside pressure because of antitrust and breakups and things like that, down 1%. And Apple, your big loser on the day, down 2.9%. And notice right where it came down to. Right, yesterday it wasn't even close to that dotted red line at 219.79. That was my target. We hit that today. We're currently at 220 on Apple. So if there's going to be a bounce that happens, tomorrow's going to be the day. If Apple gets below that 219 level, I think you got a lot more downside movement here. So there you go. Yeah, MicroStrategy was good today too. Again, that's my largest position. So it's always nice when your largest position moves up 8.9%, but still got a little bit of a ways to go. So right now I have the 350. I sold the 350s on Friday. It was funny because I put an order in to sell the 350 strikes, and I got them, but I didn't think I did. And I went and looked at them last night or the day before, and I actually had the 350. So fine with me. It can move all the way up to 350 before I have to even consider getting rid of my shares. But more upside potential would be great. I have them expiring this Friday. I'd love to get it back up to that 340, 350 mark so I can sell them more again and again and again and again. Kramer said buy 25% for each purchase. Wait, what are we talking about? What's the big thing Sailor said is coming? So, yeah, you asked me about that on Twitter. So, Sailor, what's the big thing that's coming? Multiple pieces. Number one, we talked about the strategic Bitcoin reserve, right? Which Trump signed the executive order for a strategic Bitcoin reserve, but it didn't really do much. It just simply transferred those Bitcoin from MicroStrategy over to from the Marshal Service over to the Treasury. It just transferred it over so that those 200,000 Bitcoin stay there. That's great because those will now not be sold. But it didn't acquire any new stuff. The big news I think that Sailor is implying will be more about the plan for the U.S. government to purchase more Bitcoin and now become a buyer as a government entity of Bitcoin. That is the Cynthia Lummis bill, which I've alluded to many times. They floated it in front of Congress today. They got more supporters for it. I don't know what the final outcome was because I've been pretty busy today. But ultimately, the more supporters they get for the Cynthia Lummis bill, the more likely it passes. And when that bill passes, guys, that's when the big surge happens. That's when the big surge happens. And you also have, as John puts in here, Michael Saylor's got his $21 billion worth of preferred stock offering, right? And that also could drive prices up. There was a comment. I'll make sure I get to some of these. What time I got? 11 minutes. There was a comment I want to make sure I get to from one of the viewers that was an email, I believe. Let me check. Oh, no, this was on YouTube. Let me check my YouTube here real quick, just so I can make sure I get to these questions, because there were some pretty darn good questions yesterday. Let's go to YouTube Studio, and let's go to my comments and questions. So the question was from Spyroth Dragonfly. Great name, by the way. I'm curious as to what your thoughts on projects like, oh no, that wasn't it, sorry, Stacks building on top of Bitcoin. Oh, the one I want to get to was from Jim Base. Sorry, Jim. This is from Jim. Jim Base says, Bitcoin's current market cap is $1.6 trillion, and if MicroStrategy adds only $21 billion, it will push the price up 3x. Your math is really, really off here, right? No. What you're assuming is that all 21 million of those Bitcoin are out, and you can just buy whatever you want. Here's a trivia question for you guys. How many Bitcoin are sitting on an exchange? Just type in the chat. How many Bitcoin do you think out of 21 million are sitting on an exchange? Because when Michael Saylor goes to buy these, theoretically, he's going to have to buy them from someone. And that someone must be willing to sell that Bitcoin. Aha! That's the problem. So, Jim, you're correct in thinking that if this was just some store and they could have as much as they wanted, buying 21 billion worth of Bitcoin wouldn't be a big deal. The reality is there's only 21 million Bitcoin, and a very small percentage of that is sitting on exchanges. Yeah, there's a lot of people that think, oh, it's all on exchanges. It's 2.2 million. 2.2 million. So you have 10% of all the Bitcoin in circulation are sitting on an exchange. So when Michael Saylor sells his shares of preferred stock for $21 billion and now goes to the open market or even an over-the-counter and says, I want to buy some, he's not buying out of that $20 million pool. He's buying out of a $2 million pool. And he wants to buy, what was it? Was it 750 or 250,000 Bitcoin? Where are you going to get that? That drives price up. That compounds that action, that movement compounds significantly. So yeah, it's only, not to mention some lost and some not minted. Correct. We've got about 1.1 million left to be minted. So there's technically 19.9 million Bitcoin that have been created so far. And I've already shown you guys this chart here. I love this page. There we go. There's a really cool feature on this. It's called Bit Info Charts. If you guys want, I can copy it in the chat if you want to. How many Bitcoin are made every day? 450. 450. There's and that's fairly easy to calculate out. There's 3.125 Bitcoin created every 10 minutes, which means there's 6 created per hour, right? And there's 24 hours in a day. 450 Bitcoin are created per day. That's it. And in another 3 years, this will drop to 225. It'll get cut in half. So right here it says dormant Bitcoin addresses. And again, these are Bitcoins that have not moved in a certain window of time. The industry says 5 years is the assumption for missing Bitcoin, right? That if it hasn't moved in 5 years, that it's never going to move. And now I will just go to 7 just to make it easy here. I think 7 years is probably a good time for a point of reference that if it hasn't moved in 7 years, it's dormant. It's lost. And right now, out of that, there's, call it 5 million. 5 million Bitcoin haven't moved in 7 years. I mean, it's crazy. Now, you see this one right here, this Mt. Gox hack? Well, this one will be moved. Mt. Gox is getting rid of their holdings. But look at this address right here. 53,880 Bitcoin for a total of 4.4 billion. And you click here. Come on. This is going to make sometimes this makes me ill just looking at it. So the last time that, this had some added to it recently. All right, so this one has had Bitcoin added to it, but it's just dust. It's small, little, tiny pieces. I'm not sure why that is happening, but it's very, very small little pieces. The initial deposit into this account was back in 2014 when they bought 53,800 Bitcoin. That was a $30 million purchase. So someone bought $30 million worth of Bitcoin that's now worth $4 billion. Man. And they haven't moved it. The question is that lost? All right. The address again, let me bring it up here for you. It's called Bit Info Charts, but I will put it on here because it is one of my favorites. I love it. There you go. About Bitcoin not moving within 7 years. As a hodler of Bitcoin yourself, how often do you move yours? So I don't move mine that often. So I have some that for back in 2017, 2014, that one hasn't moved. So that's what, 11 years? So I have one that hasn't moved in 11 years. And then I have a few that I bought in 2017 that haven't moved. And yeah, I don't move them that often. I have moved them off the exchange into cold storage. But yeah. I wish, Liz. Liz, I wish too. Man, I'd pray that was your address. I'm like, can I help you manage it? Please, just let me help you with that one. You got $4 billion, my friend. Let's do the wheel strategy on a $4 billion account. How fun would that be? You get a $4 billion account. You could do the wheel strategy on SPX so you don't have to trade as many. And you could literally get yourself 0.1% rate of return per month and still be a gajillionaire forever. Oh, it'd be great. The initial one came from a friend through a bulletin board, and then the second 2017 was all Coinbase. So isn't that you just shared? Could it be that there are people just holding on like you? Yes, it could be. Absolutely, Lisa. Without question, there could be people that are just holding on to theirs and not moving them. And again, I mentioned on yesterday's show, I think a lot of people believe that that's what's happening, is that people are now moving them because government's going to buy Bitcoin. Well, we don't want to be a part of that. I think that might be part of it. I'd love to be able to share it with everyone. Yeah, wouldn't that be great? It would be great. All right, well, I think I've covered this one sufficiently. To answer the question, at least from my perspective, Stagflation 2025, if I had to go out on a limb and give you a percentage probability that we would get stagflation numbers this year, I still think it's under 50%. Now, my story may change in 3 or 4 months as the data comes in. Do I think it's possible? I think it's probably the highest level of possibility that I've seen in the last couple decades that we could get stagflation. Just because the domino pieces are kind of lining up to show higher unemployment, slowing growth, and higher inflation. And if those things come into effect, we're going to be in a pretty tough spot, and I hope they're all short at that moment in time. So that will wrap up that segment. Let me real quickly run through our rest of our markets here because I don't want to do another hour show. Dab nabbit. True, Romana, or dead without disclosing their address. Or you just, something happens and you don't share your private key. I don't have hundreds of millions of dollars worth of Bitcoin, but if I were to pass away, what happens to, knock on wood, what happens to my Bitcoin, right? There's a lot of people that haven't shared their private keys. Unless you write it down, you put it in a will, your private keys, how do people know where it's at? Because if you pass away, you're going to get a letter from the bank like, hey, we've got these accounts here. You'll know if you're the executor of the state where that money is at, and you can go find it, claim it with the birth certificate, etc. It doesn't work for private keys. It doesn't work for Bitcoin and digital assets. All right, I have how many minutes? I have 1 minute left. We already covered these markets. We know what's going on. All in all, I'll just say with the S&P here, disappointing day. I thought we were going to have a much bigger bounce. I still was in that camp of a big bounce. Remember, tomorrow is the most bullish day of the week for this year. Wednesday's been a very positive day. So let's see if we get that bounce tomorrow for our equity indexes. But all in all, Bitcoin really was the bright story today, coming off the heels of a really ugly story. So if you are brand new, as Chio says, only 22 out of 89 hit that like button. Well, apparently didn't like it. Hit that like button and email me at tradermerlin@gmail.com if you have other things that you would like to discuss on the show. I'm going to go drink a lot of water, walk the dog, and then climb back into bed and hopefully recuperate. So thank you guys for the patience. Sorry if I sound a little bit out of sorts today, but certainly fighting through a cold over here. So I will be back on tomorrow. If you, again, have any topics you want me to discuss, email me at tradermerlin@gmail.com or put it down below any of the YouTube channels. And for those of you who may be new, hit that subscribe button. I'll see you guys tomorrow.